Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue from where we stopped last time. We had talked about determination of market values in the previous video. So right now we are going to look at the impact of taxation on the computation of weighted average cost of capital. So we are going to look at the impact of taxation on Wacc computations. So when we put taxation, when you have things to do with taxation, then we need to make sure that we understand that the timing is very crucial. Is very crucial because taxes, most of the times we have issues that taxes can be paid in arrears. Taxes can be paid in arrears, or taxes can be paid in the same year. In the same year, cash flows are generated. So if these are two ways, the taxes can be paid in arrears, meaning the tax for this year will be paid in next year. That is paying in arrears. But there is a scenario where taxes can be paid. The taxes for this year are paid that same year. That's what we call paying taxes same year as the cash flows are generated. But paying taxes in arrears is what most of the times happens in most countries. So we want to look at the different treatments given the fact that we have those two issues, because we've said that the timing of the cash flows, the timing of the taxes is very important in our computations. Remember, we are going to be having things to do with, we are going to have things to do with the IRR, and we know IRR uses the cash flows. So that's why here we are looking at the timing of the cash flow is very important. I know we shall learn more about the timing of cash flows when we go to the investment decision, but for now, just want you to understand that there are two ways. Taxes can be paid in arrears, or it can be paid in the same year the cash flows are generated. But now, what happens when taxes are paid in arrears? This tries to a little bit confuse students. When taxes are paid in arrears, this one is a little bit confusing for some of the students. These issues of taxation, I would have sorted them under the investment appraisal, because that's where there are many. But here, there is nothing complicated that we are going to look at, because the cash flows are not all that many. Now, if taxes are paid in arrears, it means that you pay the taxes when the year has ended. So what happens is that if you have this year, this is year one. So the taxes for this year, if let's say they are 2 million, if it is paid in arrears, then those taxes are going to be paid in year 2. So we shall have, this is how it is going to look like. You can have the years, up here. Let's put the years here. Year 1, year 2, year 3. So these are the cash flows, or these are the taxes. So what is going to happen is that if this year 1 you had 2 million, and year 2 you had, let's say, 3 million, what is going to happen is that if you are paying in arrears, the implication is that the tax you are going to, the tax for year 1, which is 2 million, is going to be paid in the second year, so it will be here as 2 million. Here we shall not be having. So the taxes for year 2 will be paid in year 3, so we shall bring the 3 million here. That is the implication. That happens if at all taxes are paid in arrears. But now, if taxes are not paid in arrears, they are paid in that same period when cash flows are generated. So if they are in the same period, what is going to happen is that these taxes for year 1 of 2 million will be paid in year 1. This is 2 million. The one for year 2, which is 3 million, will be paid in year 2. That is 3 million. This one will not have. So that's the kind of discussion that we are going to be talking about. So that's what we are referring to. When taxes are paid in arrears, we expect that it's going to be paid at the end of the year. So once the cash flow of year 1 is not affected, because if you are paying in arrears, it means the one for year 2 is going to just come and sit here as, let's say, 2 million. So the cash flows for year 1, they are not going to be affected. Just like the way this one, the cash flows of year, because this cash flow is going to come, this taxes is going to come as a negative. We are going to be deducting it. So here we shall deduct nothing because it will not be affected. So once the cash flows of year 1 are not affected, then the tax is only affecting the cash flows of year 2 and so on. Now, someone is going to be wondering, if the cash flow for year 1 here, the taxes has gone to year 2, the one for year 2 has gone to year 3, what will happen to the taxes that are supposed to be for year 3? The implication is that whenever you have taxes that are going to be paid in arrears, you add an extra year, which is 4th year. So that the taxes for this year 3, if let's say it was 4 million, it would be going in here as 4 million. Even if the other columns are empty. That is the implication, which is a little bit different from when cash flows are starting from here. Because if they are starting from here, then you'll be having 2 million here, 3 million here, then 4 million here. We shall not be needing this extra column. So cash flows, taxes being paid in arrears, it calls for us to bring an extra column. I'll explain more when we go to the investment decision. But that's the implication, and I want you to be very careful with it because it's one of the things that confuses students. So if the project was for 3 years, just like the way you are seeing here, we have to add an extra year because the taxes for that last year of the project will be paid in the coming year. So we add that an additional year. And that is the standard. That's how we do it. So this is because for the taxes that would have been paid in year 3 is supposed to be included in year 4. Even though year 4 we don't need it, but that cash flow is supposed to be illustrated, that it has gone there. So we can now we are going to look at a practical simulation that is going to help us to understand the different aspects that we have. So we are going to meet in the next video where we are going to be talking about a simulation where we will be taking on a practical simulation to be able to understand what we are going through with this. So, and once we are done with that, we shall, of course, look at the cost of capital for a convertible debt because we've not talked about it, but I wanted you to first understand this, then we'll bring in something to do with convertible debenture or convertible bond or any debt instrument that can be transferred into equity. Something small, it is very similar, but something small that we need to understand from that perspective. And once we are done, we shall go to another topic. So thank you for watching. Let's meet in the next video as we're talking about the practical simulation.